All right, so Life University. Some of you have been to Life University, but maybe it's your first time at Life University. So what is Life University? Life University is part of the educational arm, the teaching arm here at the Tabernacle. And Life University focuses in on family, finance, health, education, and leadership. And Jesus said that he came that we might have life and that we might have life more abundantly, or life to the full, or life that's satisfying, life that's fulfilling. And so we just believe that people cannot experience that life that's satisfying, that life that is fulfilling, if they're having difficulties in their finances, if they're having difficulties in their families, if they're having difficulties in their health, or education is an issue, or if there's a void of leadership. So what we intend to do at Life University is to bring in experts on particular topics that can give us some information to help us to live life better in those areas. And those 5 areas pretty much comprise the life of an individual. And so in any of those areas being out of sync can spill over to the other areas and affect those. And so what we endeavor to do over the course of this learning season is just to make it available for the community to come and to just hear some talks on particular areas that we can continue to grow in our knowledge, and not only be hearers, but to also be doers. So we hope that you'll take some of the information that you receive on tonight and successive Life University sessions, and that you'll apply it to your life so that you'll be better in what it is that you're endeavoring to do. So tonight, we are going to be dealing with the area of finance, and the speaker tonight is no stranger to me. It is one of my dear family members who is very gifted and has worked in the areas of finance for many years. And I'm excited to hear her talk. She's just started a new business, and she's helped a lot of people be able to take advantage of financial opportunities throughout her career. And I'm excited for her to be with us here at the Tabernacle. And I would like for you all to give a warm welcome to Terri Sweeney-Jenkins as she comes to talk about finance tonight.
Can they hear me? Good evening, everyone. My name is Terri Sweeney-Jenkins, and I have spent 15 years in the finance industry. I started off in banking. I was a underwriter. I've been a financial center manager, a personal banker. So I have quite a great wealth of information when it comes to finance. I recently started my own company, Turnaround 360 Credit Consultant, back in February of last year. And so my objective today is just to teach you guys how to assess your current financial situation, how to identify ways to prioritize your current expenses, and how to develop a financial recovery plan. Is there anyone out there who has an idea of what is considered good or decent credit? Actually, in today's economy, 720 or better is considered just good credit. There was a time when 670 or 680 used to be a really good credit score, and now today, if you're at about a 700, you're considered to have fair credit. Does anyone out there know what is considered good debt to income? Or has anyone familiar with the term debt to income? Absolutely. And basically what debt to income means is what you bring in per month versus what you pay out should be less than 35%. Now that does exclude utilities, but it would include like your rent, car loans, auto loans, things of that nature. So if you want to be someone who is considered financially stable, you would want to have a credit score of minimally 720 and your debt to income to be 35% or less. If you're at 35%, you are considered to be kind of teetering on being in what they consider financial hardship. So the very first thing that if you are having financial difficulty that you would want to do is you would want to examine your overhead. Do you have enough money to rebuild your financial life? How many of you in here have what is considered a rainy day fund? And what that means is if you lost your job tomorrow, if your car broke down tomorrow, do you have 6 months worth of expenses put away in an account so that you would be able to make it? The second thing is you want to look at loan payments, your mortgage, child care expenses. You want to start prioritizing debt. The less credit cards you have, the better. A lot of people have the misconception that if they have a lot of credit cards, that is showing that they have really good credit, and it's actually the opposite. The more credit cards that you have, it's the more potential you have to go into debt. So we generally tell people that you want to have no more than 2 or 3 major credit cards. And if you do have credit cards, you want to make sure that you never use more than 30% of your credit line. So if you have a $10,000 credit line, you would never want to be at more than $3,000 of that credit line. Also, you want to look at how much income you have coming in each month versus what you're paying out. You know, if you have $2,000 worth of income coming in each month and you have $1,800 and $1,900 worth of expenses, you know, that could be a sign that if something happened, you could be just one paycheck away from financial hardship. The main thing to do is make sure that you get that debt to income under 35%. The best way to do that is to start prioritizing your debt. You take the highest bill you have and you put it in order all the way down to the smallest. And you start paying them off in order. You take those small bills and you pay them off. And then as you get one paid off, move on to the next one. That's the best way to get your debt to income under 35%. Because if you're facing financial hardship and you go to try to get a loan, if your credit score isn't at 720, and if your debt to income exceeds over 35%, you're going to have a difficult time obtaining financing from a bank. So that's the very start as you want to examine your overhead. Yes, ma'am.
Is it difficult to get financing, or does your interest rate get higher?
When you're in banking, if the debt to income, even if you had a good credit score, when I was in banking and I spent 15 years in there, for example, I had a client who had a credit score of 780, but what he brought in versus what he paid out was at 85%. So there was no way that a loan could be done for him because it showed that he could not pay. He was having a hard time paying his bills, had a lot of credit card debt. So it's very important that you keep that debt to income ratio in line. The higher your credit score, the lower your rate is. Nowadays, if you have a credit score of 670, that's considered the bare minimum in the banking world. So if somebody comes to you with a 670 credit score, they're going to get a higher interest rate because that's like the bare minimum of the threshold to obtain financing. If you're under a 670, you're going to have a hard time getting financed. If you do, you're probably going to have a very high interest rate. The second thing that you want to do is you want to start to develop a financial recovery plan. The way that you start that is you want to start keeping must-have items to under 50% after your tax income. So that means after you get your paycheck, you have to start prioritizing things. Do you need that new purse? Do you need those new pair of shoes? You want to keep your must-have items under 50%. The second thing you want to do is eliminate and reduce expenses that are wants versus needs. So whenever you're trying to put your credit back in order and repair it, you have to kind of make the sacrifice. And the sacrifice that you make is if you don't have to have something, don't get it. Obviously, you need food. If you have small children, you need to pay for daycare. If you have a car note, those are things that you have to have. But if it's something that you want to go get your hair done, you want to go get your nails done, those are things that you kind of have to put to the side. Also, I encourage everyone to contribute to a retirement plan. Does anyone in here know the standard retirement age now? If you participate in a company pension plan, if you're under 59 and you got 30 years in and you want to retire, you can't even touch that pension until you're over the age of 59. So what I encourage people to do is set your own rainy day fund up. Also set your own retirement plan together by contributing to a Roth IRA. With the Roth IRA, you pay your taxes up front. So if you did need to use that money, you've already paid the taxes on it. Nowadays, a lot of companies no longer offer pensions. So I encourage a lot of my clients to invest in a company-owned 401k plan or invest in the stock market, mutual funds, annuities. But you need to start having something set up so that when you do retire, you don't have to go back to work. 70% of people who retire end up having to go back to work because they find out that they don't have enough means to survive off of. Another thing that you want to do is develop a spending plan. I always encourage people that if you want to get an idea of how your spending is, get a check register book and track everything that you spend. If you're going to use cash, take those receipts and save them. At the end of the month, add that stuff up and kind of give yourself an idea of what you spend. And then if it's something that is more than 50% of your after-tax income, then you might want to start putting a plan in order. And that would mean the biggest expense that most people have is going out to eat. A lot of people have on-the-go lifestyles, so going out to eat to Starbucks or Fridays or wherever, you'd be surprised that if you actually take 1 month and just save those receipts and add it up, what you spend on eating out. And then once again, I can't stress enough to start a rainy day fund. I encourage everybody, if money is tight, you can take something as small as $10 per paycheck and put that aside into an account. And just let it sit there and never touch it. And if something happens, you have money there. But I can tell you that if you don't have a rainy day fund at this point and something happened, you are on the verge of facing a financial crisis. The final thing that you can do is implement your plan. You want to set financial goals that will help you understand your income and expenses, which is why it's important to log the transactions that you're doing, keep those cash receipts so that you can actually understand and see what you spend. Sometimes we don't realize that spending that $3 every day on coffee, it adds up at the end of the month. There's some people who get it before work and get it after work. So you have to have an idea and be aware of what and how you're spending in order to be able to put yourself back on the financial track. Understand your goals and set reasonable goals. You know, what is the problem? Is it that some people are looking to buy a house? Some people want to get a car. Some people want to retire. So you want to make sure that you're setting goals. You want to set reasonable goals that are attainable. You want to rebuild your credit. Get a free copy of your credit report and find out where your credit is. If you don't have an idea where your credit is, then you don't know what type of financial hardship you may be facing. I've seen people have good credit because they pay their credit cards as agreed, but financially, they don't have it there. So it's the same thing. You can have good credit, and if you don't have the income to support it, then you're in a financial hardship, and vice versa. If you have the money there and you don't have any credit, you're in a financial hardship, because these days you need credit for just to get your car insurance. I mean, they base that on your credit now. So having credit is very important. Does anyone have any questions for me?
Where can you go to get a free credit report?
You can go to freecreditreport.com and you want to obtain a copy of your free credit report. The very first thing that you want to do is search for inaccuracies. A lot of times you will have things on your credit that are duplicate items. Sometimes you have things on your credit that don't belong to you. So that's the very first thing you want to do, is search for inaccuracies. The second thing that you want to do is you want to make sure that the spending limit is correct. Some credit cards don't put a spending limit, and when they don't do that, that's very detrimental to your credit. A lot of people love to have an American Express card because it has no limit, but what they don't realize is if you have an American Express card and you spend $12,000 and you pay it back, when you go into the bank, they look at that $12,000 as being capped out. So that's, a negative. Another thing that you want to look at, you want to make sure that your name, date of birth, employment history is reporting correctly. You want to make sure that if you've never been late, that it's reporting correctly. The biggest thing I see on credit reports is that sometimes people have judgments that have been paid and they haven't been removed. That's one of the biggest inaccuracies. If you do have those type of inaccuracies on your credit bureau, what I advise you to do is get with a professional and have them help you clean up your credit. Obviously, cleaning up your credit is something that you can do on your own, but it's best to have a professional because there's certain paperwork that's involved that they can assist you with. Yes, ma'am.
If you're trying to, say, build credit, what do you suggest, where do you suggest
The
starting?
best way to build credit is a lot of banks offer secured loans, cash secured loans. That is the best way to build your credit. You could take it has to be a savings account. You could take a couple $1,000s in a savings account, borrow against your own money. Maybe do a short-term loan, 12 months, pay it back, and that's the best way to build up your credit. They also have cash secured credit cards as well. The only difference between the credit cards and the bank is that the credit cards, they charge you a fee to use your own money, where the banks, you're going to get a very small rate. Your interest rate might be 2 or 3%. I always encourage people when they're building credit to not pay it off fast. A lot of people have the misconception if they do a loan and they pay it back too fast, that that's a good thing. It's not, it's a negative. If you take out a 3-year loan, never pay it off no sooner than 1 year, because if you pay a loan off too quick, that actually hurts your credit as well.
And can you get those at like any bank even, I mean, because they don't do a credit, if it's a cash secured loan, they don't take it against your credit score.
When I worked at Huntington, and I can tell you at Huntington, they did look at your credit score for cash secured, but credit unions don't. If you go to a credit union, they just want to see that the money is there, and it's called what they call an automatic approval. So, I mean, you can destroy your credit in 1 day. It takes a lifetime to build and sustain credit. And another way to sustain credit is to be conscientious of who you add on as joint owners to different cards. If you have a credit card and you add someone on as a joint card holder and they abuse the card or they spend too much, it counts against you. Also, their debt can become intertwined with yours as well. So I always tell people, unless as a spouse, refrain from adding other users to your credit cards. Yes? Yes.
So what advice would you give to some of the teenagers to get off on the right foot, so to speak?
The most important thing that teenagers can do is not accept the credit card offers at 18. I think a lot of people seen that as soon as you turn 18, the credit card offers come in the mail. I would tell them do not accept them, or if they are going to accept one, it just needs to be a major credit card, and I would leave it at one and have a parent teach them how to utilize the money, because a lot of people get bad credit at a young age. Most of the people, I see it both ways. Either they're really young and they have bad credit, or they're really older and they have no credit. And so it works the same way. If you're in your 50s and you have no credit, it's a nightmare to try to attain credit and get it started, because they look at it as to what was going on that all these years you didn't have credit. If you're 18 and you start off with credit and you have too much, then you start off with bad credit, and it's just a nightmare to come out of that cycle. So I would encourage anyone 18 and older, just do not accept all the credit card offers. If you're going to make it, Capital One is one of the best credit cards anyone can have. They have the most competitive rates. They report to all 3 major credit bureaus. And when you pay on time, every 3 to 6 months, they will increase your credit line. So when you're looking to get a credit card, that's the kind of credit card you want. You want a credit card that reports to all 3 major credit bureaus. If they're not reporting to all 3 major credit bureaus, that could be a negative. And the reason that could be a negative is because certain banks pull from certain credit bureaus.
How long would you say that it usually takes to recover from, like, bad credit?
Well,
If you're doing the right thing?
if you do these plans that I have in place, I've gotten people's credit together in less than a year doing this, but you really have to be serious. You have to let a lot of things go to get your credit in order. Like I said, you can spend all your life having good credit, and it can take just one bad thing to destroy credit. A lot of people don't realize that you can actually write the credit bureau if you anticipate a financial hardship. You can actually call the credit bureau or contact the credit card company and let them know that you're anticipating a financial hardship, and they will work out something with you so that you don't have anything derogatory report. That's something that I also advise people if you anticipate a financial hardship. Depending on the severity of what you have going on, it could take a long time, but if it's just something like minor collections, generally you can negotiate those. I had someone who had a $56,000 judgment, and I knew it was going to take us a long time to get that taken care of. But if it's just collections, generally we can get those negotiated and settled. Yes, ma'am.
What about if someone has a bankruptcy or a car repossession or a foreclosure? How does that work on your credit, and how long does that take to get off?
A bankruptcy stays on your credit for 10 years. Whether you file Chapter 11, Chapter 13, Chapter 7, a bankruptcy is always looked at derogatory. The biggest thing that happens when people file bankruptcy is they file bankruptcy. Once it's discharged, they have a lot of credit card offers coming in, and then it's the same cycle again. If you file bankruptcy, you really should give yourself a year of having absolutely no type of credit activity to allow everything to dissolve, because what happens is once you start accepting those new credit card offers, it just only shows that you had a bankruptcy and you just picked up new debt over again. With bankruptcies, let's say you were looking to buy a house, it would probably derail you for about 3 years. A bankruptcy would have to be at least 3 years old to purchase a house. If you were looking to purchase a car from a bank, it has to be at least 2 years old. And generally, you need an explanation with it. With the foreclosure, depending on how that foreclosure is done, it could report negative. A lot of people lately have been putting their houses in their bankruptcy, so that is not two separate things. But if you are facing a hardship with your house, they have a program out there called Save the Dream. And if you go through Save the Dream, they will actually work with you, and you can get up to 12 months worth of house payments paid on your behalf to allow you to get back on your feet. So generally in the bank now, before they foreclose, there's a lot of different options that they give to you. You're welcome. Yes, Turnaround 360 is actually, I'm a State of Ohio Board Certified Credit Consultant. So what I do is I work with people who do not either have no credit or they have bad credit, and I help them get into a position where they can obtain credit. Normally when people come to me, they either want to buy a house, they want to buy a car, or they have no credit and they're looking to establish credit. Also with Turnaround 360, I teach people how to be financially independent, which is teaching you how to, when you get your paycheck, instinctively taking $10 to $15, putting it away, how to allocate your debt. I do a variety of different things with it, but the bulk of it is just helping people get their credit in order. I do a lot of hand holding. I tell people that there's going to be times where they don't like me, because I do look at their receipts to see what they're spending. And usually part of the reason why you're in a financial bind is either usually you've lost your job, but The bulk of it is they're just spending that credit card debt because they think it's free money. I mean, people spend it and spend it and spend it, and then when it's time to pay it back and the interest compounds, that's the problem. So I do a lot of redirecting. I try not to call it hand-holding, but I do a lot of redirecting and help them get refocused. And usually when they're done, they're smiling, but there are times when they're agitated with me because I'll ask, why did you get this? Why did you go there? Why did you spend that? I was a Starbucks person forever and a day, and I actually started keeping my own receipts and realized that I was spending $300 a month on Starbucks. Yes, and that's because I was working in banking, so I would go there for breakfast, and then I went there for lunch, and we had sales calls, so then I would run there so I was going there 3 to 4 times a day, and it was like $300 to $400 a month, and then I added it up, and I said, you know what, I'm gonna make this something that is not a want. I don't have to have this. So it'll be something that I can reward myself with. So I switched it from going every day to once a week. Same thing with going out to eat. That's something that I only do once a week because on my way home, I would pick my kids something up to eat from a restaurant. So you'd be surprised. I was spending almost close to $1,000 just in fast food for myself, fast food for my children, because I had an on-the-go lifestyle. And I actually had to sit down and keep a register and track it. And then I started saying, okay, with my groceries, I started tracking that. Okay, every month I'm gonna put aside $300 for groceries. Every month I'm gonna put aside $100. This is just spending money for me to enjoy each month. I gotta stretch it out. And I just became disciplined, and I think that that's one of the things that I do with my customers who come to me. I teach them how to be financially disciplined. I always say that if you do not have good credit, you are living in a financial prison. It's up to you to choose how much time you want to serve.
Where are you located?
I'm located on Heidelberg, 1133 Heidelberg. I have cards on me if anyone's interested, yes. Any other questions or anything that I did not cover? I was trying to get it all in. Yes, sir.
Ma'am, can you hold my hand through this debt to income ratio? How would I go home and calculate that?
Sure. Let's say that you have $2,000 coming in per month. This is your before tax income, not after tax, okay? So you would take your $2,000 that you have coming in. Then you're going to subtract out whatever your mortgage is. You're going to subtract out if you have any car loans. You're going to subtract out if you have any credit card debt. What's excluded from that, your cable bill doesn't matter. Your utilities don't matter. Daycare expenses don't matter. These are anything that would hit your credit score. So car loans, mortgages, stuff like that. And then you're going to subtract it out. And then what you would do is take $700 and divide it by 2,000, and whatever that figure is, that's what your debt to income is. You want to make sure that that number is under 35. Some credit unions will let you get up to 40%, but the rule of thumb is you want to be 35 and under. The lower your debt to income is, the more appealing you are, because it looks as if you're living under your means. And that's what you want your financial portfolio to reflect, that you live under your means. If your debt to income is over 35%, excluding cable and utilities and daycare expenses and all of that, then you're pretty much facing some financial hardship. And I always tell people, if you do not have a rainy day fund set up, which is 6 months worth of expenses, if you do not have that set up, you are in financial hardship. Yes? Yes, ma'am.
That work for individuals who want to have an emergency fund or begin to create financial security?
The banks have products which are generally referred to like a Sure Saver account or Christmas clubs. They put it on the consumer to set it up themselves. So you would need to go into the bank and say, I want to set up a Christmas Club account or a SureSaver account, or you want to set up a savings account, depending on how comfortable you are. Generally, if you put it in a CD, you lock it in where you can't touch it, which is what I recommend, because if you're going to be putting that money away for a rainy day, you don't want to have access to it. That way you can't nibble on it just a little bit.
Are there any other questions? If not, we got one more question here, and we're gonna be wrapping it up because time is.
I was trying to squeeze it all in.
I just wanted to know if my student loans make it to the effect of credit score.
If the payments are not deferred, yes. So if your payments are not in deferment, then yes, it will negatively impact your credit score, and it will also impact your debt-to-income ratio as well.
So paying them off positive.
Unfortunately, with student loans, paying them off does not positively impact your credit score. They only hit your credit when you owe them. And it's an unfortunate thing, and that's something that a lot of students are raising havoc about. But if you're paying them as agreed, it doesn't boost the credit score. Now, I've had customers who've had a 0 credit score with student loans, showing up on there paying as agreed, and it was not helping the credit score because it's not considered anything that's part of the TransUnion, Equifax, or Experian. The loans are not in agreement with them.
So why does it negatively impact you if you don't pay?
Because it's considered a debt. So unfortunately, it'll only pop up when it's not being paid. They put it on there as a judgment. So it's not something like a credit card where it would be reporting as what we call a normal trade. It would be showing up as a collection or a judgment.
So what happens when they do pay whatever is showing up? Do it just disappear and the score go back to normal, or do it stay?
Once they pay it off, their score will revert back. It'll come off. It'll come off.
Can we give it up for Terri Sweeney-Jenkins? A very informative talk. So if you didn't catch it all, this talk will be uploaded soon on LifeU, Life University YouTube channel. So I think there's a way for you to subscribe to certain YouTube channels, and some of you are more, I see people down the head. I don't know how to do it, but I know I'm subscribed to Life University. I don't know how I subscribe to it, but I am. So I'd encourage you to do that. And over the course of this learning season, we'll be uploading all the talks, so you can go back and you can take notes and you can refresh and things like that. How many of you enjoyed the talk tonight and got something out of it? Very good. I'd like to encourage you to tell other people about Life University. And there's also a component to Life University for people who attend the sessions. They can be considered for a scholarship. There's going to be a $5,000 scholarship award to go to someone going back to school, and it will be renewable for 2 years. So come to Life University. It could be a benefit to that, right? And please tell other people about it. Also, you can like us on Facebook. It's LifeU Talks on Facebook, and there's information about upcoming talks that'll be on there. And again, refer to the YouTube channel just to refresh and review information that you've gotten or to hear some of the previous talks. All right? All right, great. Well, we're not going to hold you any longer. We thank you for coming out tonight. I trust that you learned something tonight, and that not only will you just be a hearer, but you'll be a doer also.